Hi, I'm Darren Long from Delta Harbour Assets, and on this week's Hard Money podcast, we're going to talk about Canadian real estate, silver and gold, recession, interest rates, what's coming down the pipe, why we love gold and silver so much at this point in time, and why you should be paying attention to what's happening and what the data is telling us is going to be a very long, drawn-out drop in the Canadian housing market, how to avoid being hurt by it, and why gold and silver are going to be your best friends during that period in time. Hope you tune in. Look forward to seeing you soon.
There are no shortcuts to building wealth today. It takes time, effort, sacrifice, and diversification. But today, diversification means something different than it did in the past. You deserve a more secure way to protect and grow your wealth. At Delta Harbour, we take this to heart. Our mission is to help by inviting you to add physical gold and silver to your wealth strategy. Book a free consultation today and let us show you how to protect and grow your wealth through the ownership of physical gold and silver. Let us show you the Delta difference. All right, welcome everybody. Good to have you back here for Hard Money. Into another springtime show. Looking forward to the turn of the weather and possibly an upgrade to your portfolio as well. John Scholes here along with Darren Long, of course, from Delta Harbour. That's Delta Harbour with a U. Reaching out, phone number 1-877-323-GOLD, and all of your social media, Delta Harbour with a U as well. That's how you want to search it. Reach out, have a conversation. If you have not explored the benefits of real physical metals, gold and silver is part of your investment portfolio, you've been doing other things, you've been reading stuff in the media. Well, if you haven't explored this end of it, you really should make a phone call. Use that number, call Darren, talk to the team, 5, 10, 15, 30 minutes, have a chat and educate yourself really is where it all starts. But lots to get through on the show today, Darren. As we get into this, we're going to unpack a ton of stuff over the next few minutes. So let's get going. How are things with gold and silver, by the way, now?
Well, John, it's a week in which both gold and silver prices have been range bound. They started the week with a couple of attempts to break out of that range. But thankfully for our clients, and certainly those looking to get into this market, they have remained in a very, very valuable area as far as stacking, averaging, and starting an investment in gold or silver are concerned. Gold is sitting right now in the 1925 range as we tape here on Wednesday, and silver is sitting in the 2440 to 2450 range, and both look very good. Both poised, having both recently seen new short-term highs. Gold almost pushing to its all-time high, and silver pushing up to the $27 range. Both look very poised. And again, there's a ton of data out there to suggest these are going higher. But banks are going to, central banks that is, are going to fight tooth and nail to prevent their economies from sliding too quickly. They know recession is coming, stagflation, as we've talked about it. They know interest rates are about to go higher. It's going to kill the golden goose. We're going to talk a little bit about real estate today, but ultimately, John, both gold and silver representing great value right now, especially for those that are tuning in for the first time and want to take a position in either of those two metals. Remember, we do physical, so you are actually buying bars or coins of gold and silver with the option to store or take it home. But John, both metals look very good right now. And if I was a averaging investor, cost averaging investor, or an investor looking for a good entry spot, I'm picking silver as my champ of the two this week. Right now, as the most undervalued metal on the face of the earth.
Well, last week we did chat about a couple of topics in real estate and the possibility that we see recession sooner rather than later. With the side of stagflation, that term you just mentioned, I saw the BMO has now come out and are basically the first bank to suggest the housing market's starting to cool right off. What's happening there?
Well, as we said last week, impact in the housing market is already starting to occur as it is in the broader based economy. Canadian real estate prices are approaching what we called last week a mile-long stretch of hurdles. We have the 7th tomorrow. We're taping on Wednesday, so tomorrow we have the budget to unpack, which we'll do in a minute. The possibility of new taxes are quite high. In fact, we just witnessed the increase in non-resident buyers tax, which makes it far more difficult and far more likely that we'll see a drop in the numbers of non-domestic buyers. People who are maybe overseas looking to buy or get into the Canadian market. they're going to have to pay a substantial tax to do so. And most provinces are following suit. Even some that we never thought we'd seen, like places like Nova Scotia and others, are even adding their own little tax. In Ontario, it's up to 20% right now. So that's a hefty tax bill to pay just to participate in the market, which analysts predict is at the very top end of where it's heading. The April 7th budget might add more to that. And we've had, easy credit conditions. We've had the reversal of those easy credit conditions start to happen. Interest rate hikes, they've begun with a quarter-point rise. Now analysts are saying we're going to see 50 points. So that could be 0.5% at a time. And they're now saying we could see as many as 2 in a row, which are going to become more of the norm, John, as they try to cap inflationary pressures. And since the Bank of Canada acted late, and again, I don't believe they're going to be able to cap inflationary pressure. So let's put that out there right now. Another reason why you should own gold and silver for sure, hands down. But since the Bank of Canada acted late on inflation, they'll need to use more firepower to tame it. So these half-point interest rate rises are more just the verbiage they're going to use and the only real tools at their disposal to try and fix this. But ultimately, this ends up right back at where we began, which is probably quantitative easing. So at some point, we'll see more money printing, fix the holes, recession, stagflation. And as mortgage rates start to rise, yes, the capping of the home values finally that will sit in place or slow down to a very small amount. Variable mortgage rates should be in and around probably by end of summer, early fall, 3% and or higher. And that's going to be very weighing on the mortgage industry. And of course, as we said, BMO wrote this week as the first bank in Canada to really acknowledge that this choppy data coming out of 2 major markets in Toronto and Vancouver are pointing towards early signs of price discovery. And essentially what they're saying is, we know it's a couple of weeks before we get the major data across all the data centers in Canada, but this early warning of new price discovery is a sign, with higher mortgage rates projected to climb much higher and faster than anyone figured, that there is shifting sentiment below the housing market sector right now. So annual home price growth is slowing down. It's grinding more so to a halt in both Vancouver and Toronto, which are the 2 major markets in Canada. And Toronto real estate has seen annual growth fall to 34.8% in March. Now, that's a lot. Don't get me wrong. 34.8% year over year is a huge amount, but it's less than what the year-over-year rate was the month prior to that. It's still a huge gain. And so a lot of people are going to gloss over that, John, and say they expect things to continue on the same path, see spring rates go up. But this is what we call price growth deceleration, which is occurring right in front of our eyes. And that slow in growth might not be obvious, but it is sure as a sign that a slowdown is happening. Annual price growth in both markets, in fact, is expected to continue to slow down. And if the Bank of Canada follows through with what they say will potentially be 2, not 1, but 2 50-point rises, that's a full percent within a couple of months. And so that will slow everything right down for sure.
Well, I mean, that's certainly interesting because it really sheds light on how fast the landscape is it's really changing, doesn't it?
Well, it does, John, to be honest with you. Price growth is showing early signs of slowing, but it's far from a clear picture for sure. I mean, I'm not suggesting that the housing market is about to melt in front of us. Higher interest rates are only one aspect of that particular equation, but prices are still rising significantly on the index, and a month isn't a trend. BMO goes on in that note to their clients to say it's not clear where home prices are heading from the current data, but we know it's a flattening of the price growth we have witnessed for the last 36 months. And the housing market, and I quote from this note, housing market results from the major cities are coming in right now, but they are probably going to yield a cloudy picture for a while. And they added to that note, and again in quotations, a new round of price discovery seems to be underway amid higher mortgage rates and shifting sentiment.
You mentioned price discovery, Darren. Explain that a little more to our listeners and what it means for real estate.
Well, price discovery simply, John, is the process of establishing asset value after a fundamental change in the market, such as a rise in interest rates or another significant change. During this phase, some homes will continue to sell at much higher prices depending on the area where you're at, or the demand for that center, while others will probably sell much lower as buyers start to become split on the trend. So they're looking at that particular region and saying, hey, this is an outlier. We're not in the core of some major metropolis. We're not in Toronto. Now we're talking suburbs or rural areas. And so we're not certain that that price trend upwards is going to continue. And the uncertainty also tends to create more sellers looking to mitigate risk. So they look elsewhere. So, you don't know how flooded the market is going to be, because they're going to just start to dump like crazy, thinking they've missed the top of the market. Now, it's too early for the first rate hike to fundamentally shake the market like it has, but psychology changes very fast, and home prices fetching an emotional premium, they don't reference the fundamentals. They're based entirely on the belief, just the belief or the confidence of the buyers and sellers and the agents that are involved in the process, that they're going to continue to rise. And if that belief is shaken psychologically, the gap between fundamentals and exuberance begins to close, which the early signs are pointing towards. The housing market, if you look at it, after all, is really just a self-fulfilling prophecy. When prices rise, people are desperate to purchase because of what we call FOMO, or fear of missing out. Buyers rush in convinced the price of the house or that region or that area is going way, way higher. So they're tempted to get in there before it happens and buy, and it causes the housing prices to continue higher and higher and higher. And that's worked in a very short period of time, because let's face it, 24 months, 36 months, that's not a very long period of time in the grand scheme of things. But when prices start to falter, people are hit with what we call FOOP, which is fear of overpaying. And so when that hits in, buyers back off because they're afraid houses are going to lose value or be worth less very soon. BMO, in their notes to their clients, lastly, they added, we could easily, and I quote, we could easily be in for an adjustment period similar to that seen when the Bank of Canada and provincial policymakers tightened up in 2017-18. It might take a few months to show up in the official data, but sentiment seems to be changing out there. So it remains to be seen, but we expect this to be part of this puzzle, and yet another reason why you lighten the load in that particular arena in favor of others like silver and gold.
Again, reaching out anytime to Darren and the team, 1-877-323-GOLD. It is just that simple, deltaharbor.com, Harbor with you, of course. So how does the budget fit into all this?
Well, again, we're taping on Wednesday. So tomorrow, which is Thursday, April the 7th, the Trudeau-Singh party is going to drop their next budget, and it's expected to contain its own set of what will be viewed as anti-real estate measures. And again, as we've mentioned already, there are certainly things that are occurring that are going to be already working towards cooling the housing market, like interest rate hikes, and of course the non-domestic buyer tax that's been implemented. But that could, this budget, yield yet another rise in the national tax on non-resident buyers, along with measures to whack investors, such as requirements for some saying 35% down payments on rental properties, right? So if you want to declare it as a rental property, you're going to have to put up a minimum of 35% of the value. And with home values on average, in the suburbs, GTA, at 1.5 million, in that range, that's a big chunk to have to put down. So that slows the amount of speculation in the market. And then in addition to that, they're talking about a potential ban on using home equity lines of credit towards more speculation. Also bans on loans or gift money in a transaction. So if mom and dad are going to gift you some money or loan you some money, can't be unless it's for your primary residence. In additionally to that, the feds have said they will attack REITs, which provide a pool of rental housing. And REMAX came out with a piece last week suggesting that the capital gains tax exemption on residential real estate may be in play also. We don't know. We're going to see. But in summary, if our listeners are paying attention, listings are going up and activity is going down. So with these mortgage increases, it's important to recognize they've only just begun, John. And ultimately, the people who run the place are determined to distort, twist, and alter the market, mistakenly believing once again that, and they've done this so many times, well, things will become cheaper when taxed extra, but usually they just get more screwed up, which is what I think we're heading towards. So from an investment standpoint, this is the place where usually a big pile of people, which we call last in, first out investors, start losing their shirts. And we think it's time to take stock, evaluate, and simply just make changes based on knowing this data ahead of time. Bulk up on other assets which perform very well during recession or stagflation. And again, that key concept of owning gold and silver is front and center there because they have been among the best performers during those periods of time.
Okay, so seeing this happen and knowing as you do that a lot of Canadians they've earmarked dollars to invest in the real estate sector, what advice would you give them?
Well, think twice. That's the first thing. If you're watching this video, and we said the same thing last week, be smart and astute. You got to think forward, put a little bit of time and effort into saying what is the next thing to occur. If it's a downside in the market, you don't want to be buying assets that you're looking and banking on to appreciate, because what we saw in 2008 in the subprime crisis was that people were putting down minimums or as little as possible, and the reversal in value in those home properties from those valuations, it consumed and gobbled up all of their equity. So they were in negative equity situations, which led to foreclosure because they didn't have the money to lay out. They were laying out as much as they could muster up to put down in that house, which was very minimal, 5-10%, and trying to skirt all of the different policies that were in place to prevent them from doing that. And then they end up losing their shirts because those houses were foreclosed on because they couldn't come up with the equity to rebalance their portion of outlay. What performs well? Think about it. Look at the charts. Gold and silver among the best performers during inflationary periods or where there is a serious threat of inflation long term. 2008 and 11, the perfect example, right? 36 months in which we're recovering from this monumental global financial crisis. Gold jumped from $650 to $1,920.
Yeah.
I mean, anybody that invested in it made a fortune, made a killing. Yep. Silver went from $850 to $49. And so really what we're just suggesting or advocating is look at the concept of diversification. Do you need to speculate in housing right now? Is it the most critical thing that is on your plate in terms of what could potentially produce a return on investment? I don't think it is. I think once you know the data and see it laying there before you, the confidence of the housing market is starting to wane. It's slowing down. Home prices are starting to show gradual slippage. And of course, is it easy to see a 15-20% drop in housing values? Yes, it is. It's very easy. Think of how far it's gone up. As we said, the March figures show a 36.8% increase year over year. So to see a reversion of just 15% on a house that's worth $2 million, you're only talking about $300,000, right? So it's not a big move, John. And remember, there's no limit to how high the Canadian government might take interest rates. At this point in time, the sky's the limit. There is no limit. We could go up to double digits very easily over the next 5 or 6 years, trying to get ahead of this inflationary pressure and this period in which everything is just killing us in terms of higher costs and supply and demand fundamentals and supply chain problems. And if we don't get ahead of it, they're just going to keep raising rates because that's the only tool they have left. And so we want to trim the fat from our portfolios, have cash on hand. We want to eliminate anything that is not going to perform in a downturn. And, we want to recognize the warning signs that are pointing towards inflation and stagflation and rising interest rates, high oil prices, a lack of wage growth, wage disparity. There's all kinds of things, and recognize the importance of understanding that very little will be said leading up to the recession. One bank has said a little tiny bit in the US. That's it. Now several will come out and start to bounce around the concept of the ideas. but it'll be too late by the time you recognize it in the mainstream. You got to get ahead of it, be astute, be forward thinking, and be in control of yourself. Be your own central bank, as we always say, and physically add gold and silver to your portfolio.
Again, reaching out 1-877-323-GOLD is always a good way. Delta Harbour with you, deltaharbor.com. Let's bring it back into your wheelhouse, pal, as far as physical gold and silver, precious metals, getting that portfolio in much better shape. What are your options to buy?
Well, let's start with the simple one, direct home delivery. I brought a couple examples today because it's important to see this. But, you can go on our website. Here's for example, a 10-ounce Royal Canadian Mint bar. That's an example, just one example of a bar that we sell. We also have these same size bar, but in the different variety, different manufacturer. These are the PAMP 10-ounce silver bars. Again, those are two options people can take for home delivery. Maybe some more people are familiar with the 1-ounce bars of gold. That's in PAMP and Royal Canadian Mint there.
Nice.
And we like to always have those in our portfolio. For people who want to buy maybe a kilo bar, there's the PAMP Swiss kilo silver bar, and the list goes on and on. So home delivery is the first option and the easiest, John. We can do that through our website. If you want to speak to somebody, that's great. We're here to take that call and to hopefully serve your best interests and to answer any questions you have and have an ongoing relationship. But if you want to take it a step further and you want to be safe and you want to have liquidity, which means buying, selling by phone call, but still have access to your bullion, storage, it's an option. It's 1% of the total metal value per year. And it couldn't be easier. You put it in there. It's on a rack in your name, segregated from everything else. It doesn't get commingled. Your receipts there, your inventory's there. If you have serial numbers and you want them, we can get those for you too. And you can always increase or decrease your holdings and take them out whenever you want. Set up a time to go and pick it up and audit your holdings. It's a really, really unique experience. Only a couple of dealers in all of Canada offer it the way we do. And that's an option for you. Third is the Delta Vault account, which is bulk bullion. Let's just say you're listening to this and you love the idea of owning gold and silver, but it's cumbersome. You don't want to store it. You don't want to take the risk to take it home. And frankly, you just want exposure and making sure that it's physical bars you're getting exposed to or coins. So we have the bulk option, which eliminates almost down to nothing the premiums you typically pay in the market. In the coins, for example, you get as much as a $10 per ounce premium because the price that we buy from the Royal Canadian Mint with the supply and demand situation the way it is very high right now. And even though our margins are very small, it's still costly to buy that coin. So an alternative would be to get into the bulk bullion account. It's stored product, again, can be audited. We can insure that product one-to-one, so there's no concerns, and there's no sharing. It's not commingled. Every ounce you buy is backed by an ounce in that vault. We just happen to buy in large increments of silver and gold, which means we can offer lower premiums. For example, buying 1,000-ounce silver bars and allowing our clients to have as little as a 40-cent premium when you're buying into the market, in addition to the premium we charge for our service, which is, in between, let's say, 2 and 5%, depending on the volume of bars you're buying. So you can get that option, and it's a lot cheaper, still can convert at any time down the road if you want to pay that premium for that bar or coin down the road, and it might drop. So it's in your best interest to consider that option as well. And the beautiful thing about that, John, the Delta Vault account with bulk bullion in it, it also allows you, as you develop this account and get into it, to leverage. So you can use what's called collateral financing. You can use your underlying silver or gold as collateral to finance and own more product as the price is going higher, or right from day one to kind of cost average those prices. And that means you can either keep your powder dry. So instead of laying out 20,000, you can put up the minimum of 20%, or put out 4,000, 5,000, whatever you feel comfortable doing, and hold back the rest. That means you're keeping powder dry. That means you got something else to put into the market to effectively offset the cost of borrowing or using this in storage. And so that way you can really, really maximize your return, or alternatively, take an ounce and turn it into 3 ounces if you want. I mean, the option's there for you as a buyer, but that account does it. We can send information on that. Or last but certainly not least, the registered accounts. You can put gold and silver into your TFSAs, into your RSPs, into our ESPs, liras. And it doesn't matter if you're with another institution, we'll show you how to do it and what has to be done and all the steps involved. Or if you're just starting a brand new account and you want to put new money into it and you want to set up a monthly deposit or anything like you have currently, you can do it with actual physical bars of silver or gold, right? You can actually put these types of bars right into an account. Awesome. TFSA, RSPs, and we'll show you how to do that. And it's really easy to do. Those are the 4 main account options. And all you have to do is connect with us, John. Use the number you're throwing out of the website, and we'd be delighted to discuss those options with you further.
A lot of stuff covered again on this week's show, Darren. Wonderful stuff. You got to reach out to Darren and Rob and the rest of the team. If this is all new to you, that's fine. You just got to get your toe wet. How do you do it? Reach out by the phone and have that conversation. As I've been saying for the last half hour, that's 1-877-323-GOLD, 1-877-323-GOLD online. DeltaHarbor.com as far as YouTube and Instagram, Facebook, Twitter, all that. It's Delta Harbor with a U as well, all over social media. Hard money done for another week. Good to see you again, pal. And we'll do it all again next week as well.
Take care, John. Bye for now.
You bet.